Hello everybody. Today I want to talk about what are calls and puts. Calls and puts are option contracts, and I think that's a good way to think of them. It's a contract. If you buy a call, whoever you buy it from guarantees that they will sell it to you at a specific price, regardless of where it's trading in the market. That price is called the strike price. So if you buy a call from someone, and remember on every trade there's a buyer and a seller, so there's someone on the other side of the trade. If you buy a call that has a strike price of $20, you have the right to buy that stock at $20 at any time between then and when the option expires. Just like regular contracts, option contracts expire. So now you have the right to buy the stock at 20, okay? And if you buy one contract, it's 100 shares. Now let's just say the stock is trading in the market at 15. Well, your contract's not going to be not worth that much, because why would someone pay you for the right to why would you have the right to buy a stock at 20 when it's trading at 15 is not going to be worth money. I know I'm jumbling my words here. Now let's just say the stock is at 25 and you have the right to buy it at 20. Well, your contract is now going to be worth at least 5 points or $500. The reason why people like to buy options is because you get leverage to get into that position where you made $500. Well, let's just say the stock was at 19 and the call was at 20. Well, maybe it only costs you $100 to buy the call, and then you get a return of at least 500. So if security is above the exercise price when it's a call, the call is called in the money. If it's below it, it's called out of the money. So once again, a call is a contract that gives you the right to buy a specific security at a specific price up to the expiration date. When you buy that call, there's someone on the other side of the trade there that's guaranteeing that they will sell it to you at that price. A put is the opposite. A put gives you the right to sell a security at a specific price, which is called the exercise price, up into the expiration date. So if you think a market is going to go down, you would want to buy the puts. Now, just say you have the right to sell it at 20 and it goes down to 50 and the stock is at 15. Well, your contract is going to be worth at least 5 points or $500. Let's just say the stock is at 25 and you have the right to sell it at 20. Well, that contract isn't going to be worth much because someone could just go out into the market and sell it at 25. So they're not going to sell it to you at 20. Now, options, these are option characteristics. We have the asset, and I'm going to just refer to stocks because my background is mainly as an equity trader or stock trader. Cryptos, though, futures, options on bonds, options on ETFs. The quantity is one contract is 100 shares of stock. The expiration date, which we mentioned, is the date that the day that the contract expires. The strike price is the price that you agree that the security can be bought or sold if the option. So the strike price is the price where you can guarantee that you're going to buy or sell at whatever the strike price is. Now, these things are all set in stone here, right? When the options exchanges issue these contracts because they make money if people are trading on their exchange, the premium is set by the market, all right? So it's very important to pay attention to the premium, and we're going to talk about that. These are things to consider too. Open interest and volume. Open interest is how many contracts there are in existence. Volume is how many have traded on a particular day, and liquidity. Now, if you're trading puts or calls on Apple, remember, if you think Apple's going to go up, you're going to buy a call. If you think Apple's going to go down, you're going to buy a put. Apple is very, very heavily traded, so there's really not going to be any issues with liquidity. Every stock or every option has what we call a bid and an ask, and the bid is currently the highest price that you can sell it for, or the highest price anyone's willing to pay for it, and the ask is the lowest price anyone's willing to sell at. So when you get a stock like Apple, you get a spread of like literally 1 cent. The spread could be 20 cents to 21 cents. So you don't really need to worry about the liquidity. If you go and you sell it, you're going to get a price right at those levels. Now, if an option is illiquid, meaning if there's not a lot of open interest, there's not a lot of volume, and there's not a lot of liquidity, well, the spreads there can be really, really wide. It could be like 50 cents to $1. So you see it trades at $1 and you think, oh, gee, that would be a good price for me to sell mine at. And you go and you sell it and you get 50 cents. And you ask yourself, what happens? Well, the last trade that at $1 was someone taking the offer, right? That's someone buying it from whoever is willing to sell it at the lowest price. If you go in and you sell it right after that, you might get 50 cents because that is the highest price that anyone is willing to pay. So the bid and the offer. Bid is where you can sell, offer is where you can buy. Now, let's just talk about the premium, because like I said, all the other characteristics are set in stone. This is the only one that can fluctuate. So the option premium is generally defined as the intrinsic value plus the time value plus volatility and popularity. This could add to it too. The premium is intrinsic value. What is intrinsic value? Well, it's how much your option is in the money by. If you have a call that gives you the right to buy it at 20 and the stock is at 25, you're going to have 5 points of intrinsic value. If you have a put and you have the right to sell it at 20 and the stock is at 15, well, you're going to have 5 points of intrinsic value. If you have the right to sell it at 20 and it's at 21, well, you're going to have no intrinsic value. On the other side of the coin, right, if you have a call that gives you the right to buy something at 20 and the stock is trading at 19, well, you're going to have no intrinsic value. Now, the time value is when we buy a contract, right, the longer out that it is, the higher the time value, because you have to pay more because you have a longer time frame for things to potentially go your way. So a call that gives you the right to buy at 20, right, and the stock is at 25, you have 5 points of intrinsic value. If that option expires next week, well, maybe you have 1 point of time value. So it's going to cost 6. So we got the 5 of intrinsic value and the 1 point of time value. Because it's expiring next week, that's not a lot of time. Let's just say you have a call for 20, the stock's at 25, so you have 5 points of intrinsic value, and the contract expires in 6 months. Well, that's going to have a much higher time value because there's more time for things to go your way. So just say, hypothetically speaking, you could have 5 points of intrinsic value and 5 points of time value. So your cost is going to be 10. Now, when things are really volatile and really popular, that brings up the premium as well. So you're going to have a much higher premium on something like Tesla than you are on something like calls on, say, International Paper or a kind of a quote unquote boring company. So the intrinsic value is the difference between the strike price and the market price. It's the amount the option is in the money. So time value increases the farther out the expiration date. The more time you pay for, the greater the odds your idea may become profitable. So that's why you have to pay more money. Because on Wall Street, there's no such thing as a free lunch. And higher volatility or popularity can increase the premium as well. All right. Thank you, everybody. I hope that helps, and I will talk to you soon.